Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 291st VideoCast podcast for the week ending May 13th, 2025. We're live from New York City this week. Very excited to be here. Next week we'll be from Dubai. We got tomorrow, we've got the Clayman Countdown at 3 o'clock on Fox Business. We got Yahoo at 10 a.m. for the full hour, Yahoo at 12:30 from the New York Stock Exchange, and then on to Palm Beach to play with my buddy Mike Bennett. Excited to play Banyan on Thursday. And then Miami Money Show for 2 days. Look forward to seeing a lot of you down there. And then off to see my friends in Dubai and clients. And then we'll be back next week. We think we're going to be doing this Tuesday or Wednesday from Dubai, so tune in for that. Here is the message for the week from Caitlin. No water polo or swim meets this weekend. Instead, we had a girls' weekend. We went to a music festival on the beach by our house called Wango Tango. Carrie and Kim and their Caitlin's friends Carrie and Kim and their kids joined us, and then Mimi and Annabelle made Mother's Day cards. It was a fun Mother's Day weekend. We celebrated last week. Caitlin's had her eye on something I was able to get for her, so she had an awesome Mother's Day, and then went out to Connecticut to play with at my East Coast club and see all my friends in Connecticut, which was awesome, and then was able to go see my mom in New Jersey on the way back to the city. So it was a great Mother's Day weekend all around. There's Mimi and Annabelle. There's Mimi and Caitlin. Mimi and Annabelle again. That's Caitlin with her friends, Carrie and Kim. Mimi and Annabelle at the concert. And then these are my buddies in Connecticut. Came out to see me at our friend Raphael's restaurant, Gallo. You got to check it out. Great Italian food. Steven, Brendan, Rick, Mark. Super great time. Thanks for coming out. Thanks, Rick, especially. He contributes more to this podcast than you know. And then got to see a few of my favorite people in the world. You know, Robert and Desiree. I shared with you about their house in Hawaii. Desiree, if she hasn't won the club champion, she's been runner-up. She's unbelievable. Robert became a 7 index in 3 years. Talk about an athlete. And then Blake is lighting it up. I mean, Blake's going to be a plus by the end of the year. I can see it. He is just on his game. It was so great to get together. It was super windy. It was a little bit of castaway weather for us. My game, on the other hand, was not good. It comes and it goes. And in the case of Saturday morning, coming off the delayed United flight at by the time I got to bed, 2 a.m., and then getting up at 7 a.m., it didn't come together for me as an understatement. This morning, got to join, that's Mr. Wonderful, Kevin O'Leary. Super nice guy, by the way, in the green room. He was beyond nice. I told him, look, I got to get a picture or my daughters are not going to let me back in the house. And he was like, of course. And we talked about some things. He was just in the Middle East, and I'm going next week. So shared some stories from that, and really nice to meet him. That's at the New York Stock Exchange. That's Kristen Scholler's booth at the New York Stock Exchange. That's Fox and Friends outside the Fox studio. This is the building for the newer people joining us. This is one of my favorite people in the world. Besides Stu, of course, is Yasha. She makes everyone look beautiful, even the ugliest of mugs. Good job, Yasha. This is the New York Stock Exchange. This is Diane King Hall, now at Schwab Network. I know her back from her Yahoo days. Love going on with her. And, of course, Kristen Scholler. Absolutely awesome time seeing you down there. And then I said, hey, if you get swag, the Hedge Fund Tips swag, if you want to send in a photo, we've gotten dozens upon dozens of orders, starting to get the photos come in as the orders are delivered. Not everyone's going to want to send photos, but I wanted to shout out John Croner. He's been a supporter for several years, 3+ years. He's been listening to the podcast, and he was the first one to send in his picture with his hat, with his mug, with his Baba and Cooper Standard screen parabolic move. This is a successful businessman from the Midwest. His Baba's chart going parabolic, moving back up. So super excited for you. We'll get together, 5-10 of those in the next month and post them here under number one hedge fund podcast link at hedgefundtips.com. While you're there, click on terms. This is all opinion, not advice. For those of you who want to see the merch, you can just scroll down and click on the hat there and go from there. I'm wearing mine today as well. Don't leave home without it. Then we had the chance to go on, which was absolutely awesome, with Kevin O'Leary and the great Stu Varney, and talk about inflation, talk about the Fed. Want to thank Christian Dagger and Stuart Varney for that. We're going to listen in here.
Yeah, I could use some of that. Let's get to the latest read on inflation. Here we go. Cooler than expected in April. Consumer prices up 2.3% in the last 12 months. Core inflation, that removes food and energy, up 2.8% in the last 12 months. I want to show you consumer energy prices. They came down nearly 4% compared to the same time last year. That's a sign that Trump's plan to unleash American energy is beginning to work. Tom Hayes joining me to cover the market. Has the inflation news from today kicked us into another rally mode?
I think so. I think, look, we've had the mother of all short squeezes. In the beginning of April, there were record forced sellers until Trump put out that tweet on April 9th. He said, now's a good time to buy stock. The market's up 14%. Now you have record forced buyers. And I'll tell you what, with these inflation numbers, I think too late Powell is going to be a real thing. Inflation is lower than it was in September when they cut 50 basis points emergency cut. They're 150 basis points too restrictive right now. So I think you're going to see those odds come back a little bit for June, even though they went out to September as of the last few weeks. And I think there's huge opportunity here. Then you take earnings were double what was expected this quarter in spite of all the uncertainty. Guidance has held strong. So we're very constructive on this market. Every new trade deal creates more forced buyers that sold $1.1 trillion of equities at the exact low in early April.
Did you know that you picked up my habit of emphasizing points? I do that all the time.
I copy the best.
You're both drummers.
So, okay, let's summarize here. Second half of the year, going into the second half of the year, you see a nice rally going.
Yeah, and I think it's going to be under the surface. If you look at equal weight relative to cap weight, there's huge opportunities. So many of these companies that were hit by the perception of tariffs, which is no longer an excuse for the Fed because they cut the tariffs, are down 50%, 60%. And these are great companies that have made it through many cycles that are going to come back, and they're going to come back very strong. Look at Stanley Black & Decker yesterday, up 17% after the China deal was announced. Home building is going to come back the second half when Bessent works on the long end of the curve with the SLR. That's going to bring down the 10-year Treasury by 30 to 70 basis points, and you're going to see a boom in housing construction also as Trump opens up federal lands for starter homes.
You have become our resident bull. One of many, actually, but that's all good stuff. Yeah. Tom, thanks very much indeed.
Thank you, sir.
House Republicans just on.
And we're back. And then yesterday I had a chance to go on the Big Money Show and do the full hour with Taylor Riggs, Brian Brenberg, Jackie DeAngelis, Dagan McDowell on Fox Business. This was awesome. Thanks to Stephen for cutting down the 40 minutes to the most important 8 minutes. So we're going to listen in here.
Welcome back to the second hour of the Big Money Show. I'm Dagan McDowell, joined by my co-hosts, Taylor Riggs, Brian Brenberg, Jackie DeAngelis, and joining us for this hour, Great Hill Capital Chairman Thomas Hayes. Thomas, how do you invest in this kind of environment? Because it is a market that is very much driven by what the White House is doing. That's right. So it's trade, tariffs, trade negotiations. Where does this go from here in 90 days when the reciprocal tariffs on all the other nations expire in July? But then the president also comes out with this order on prescription drugs.
Yeah.
And if we can take a look at the prescription drug stocks coming up in a minute, you're really invested based on, I don't want to say whims, but certainly the maneuvering of the White House. And if this was so bad, wouldn't the drug makers be much lower?
That's absolutely right. I think what Charles said about a lot of people resisting it is so true. You know, right at the lows in early April, you had one record selling in the hole by hedge funds and by CTAs. They sold $1.1 trillion of equities at the lows in April. So now what you have, as you've had this quick move up, and then today the good news, is you have a whole slew of forced buyers that are not only covering their shorts, but are forced to chase up. So that is going to persist for a little bit. And then you couple it with the fact that even in the face of all of this uncertainty and all the headlines that you mentioned, Dagan, earnings came in twice as good as expected. 13.4% earnings growth versus 6% estimated. Estimates didn't even come down that much for 2025. They came down from 270 to 265, about 3.6%. But 2026 held up in the face of this. So now that the floodgates are open, that they've kind of resolved this looks like a reasonable path forward. Now managements can have some confidence in moving ahead with investment, moving ahead with the different projects that they had on hold. And we're going to get through this.
Hard to paper,
Yeah.
which they are, then that the market could see some disappointment.
I would say one thing about that, Jackie. It's like Warren Buffett always said: if you wait for the robins to sing, it's already spring.
Right.
So, you know, we did a conference call with our clients on April 7th when things looked really, really dark, and we went company by company, and we went through their free cash flow, we went through their revenues, we went through their balance sheet, and we said, look, this is headline noise. These are durable businesses that have made it through multiple cycles. So ignore the short-term headlines. Yes, it's creating a lot of volatility.
You know what they survive the most?
Yeah.
High rates.
Yeah, well, I think Bessent is on top of that, managing the long end of the curve. They're going to deregulate the banks. The banks are going to be back in the market, and he's going to be able to take control of the long end of the curve. I remember when the 10-year yield went up to 4.80, and everyone was saying 5%, 5%. I said, we're going below 4 before we go above 5. And I'm holding true to that. And I think the second half, the biggest surprise in the second half of this year is going to be you're going to see mortgage rates, 30-year fixed rates under 6%, and you're going to see a boom in housing and construction and suppliers to housing that we haven't seen in years, and that's going to be fueled by the Taylor Riggs of the world that are having new families, moving out to the suburbs, having
Are you moving to the
kids.
suburbs? You buying a house? No.
Buying extra cars,
But the sentiment
millennials.
is there.
You bet.
Here and get a good tax cut done with corporate tax cuts, man, I might be with you in the second half of this year that it could be really impressive.
Yeah, there's no question. You know, it's interesting. Trump put out that tweet or truth on April 8th, and he said, now's a good time to buy stocks.
Yeah, no.
And that was
In
the bottom.
hindsight.
And it absolutely rallied. And then last week, he did the same thing. He said, watch out. You know, there was a little uncertainty last week before the UK deal. Watch out. America is going to boom. And that was the intermediate term bottom. So you got to listen to the president. This guy is on fire. I mean, his calls have been working, and it's substantiated by earnings. And now we're getting certainty. And I think we move to growth, just like Brian was referencing, when we start the massive tax cuts and the deregulation with banks, with industry, with bringing manufacturing, make it easy to get zoning and so on.
So this is 30 years old. Yeah. Until they do that, when I now have parents asking if Newark is no longer safe, what does that mean then for consumer confidence? And then does that urge Congress to step up?
I think they will step up. You know, you used to fly into New York Airport, and Trump used to say it's like the third world country. They were ugly, they were dim, they were outdated, they were old. They eventually got them fixed. JFK looks pretty nice.
LaGuardia
looks pretty
better.
nice.
Yeah.
Newark is starting to come around. I sat in the airport in Orange County on Friday. Bump, 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 bump. United to Newark. That was my direct flight all the time. Once a month I come out here. I was supposed to be here 3 o'clock in Newark. I got to LaGuardia like midnight. So it's just part of the thing. They rerouted me. They'll work it out. I will not be flying into Newark for the next few months. I'll be flying into JFK or LaGuardia. But as far as consumer confidence, I think they'll just adjust. They'll adapt. They'll get things fixed. They'll get the money from Congress probably quicker than we expect because a lot of people have been hurt by this, and we'll move forward. From an investor standpoint, I would use the opportunity. Any dip in high-quality airlines is an opportunity to buy. Consumer confidence with these trade deals is going to come back. Travel is going to accelerate into the summer like it does every single year. And we'll be looking for opportunities.
Oh, you're so glass half full today.
Opportunities in the crisis.
He's very optimistic.
Constantly on the phone, which is so disruptive to your sleep cycle. So that's what I need to work on.
Well, you could just become a golfer, because if you pull your phone out while you're golfing, people will give you the evil eye. Do not mess up the round. So I do it in small doses, 4 hours at a time. But beyond that, I think if I was disconnected for 1 day or 2 days, my clients would fire me. So I need to be available, but 4 hours at a time.
Even at the retreat, you get to use the phone in your room.
Yeah.
So you wouldn't disconnect that
Send your
long.
clients on the retreat, then they'll never contact you. They'll be the best of all worlds.
Dagan, this one, in theory, doesn't have to report to an office, but it's because your computer is right here.
That's right. With opportunity comes responsibility. So if you can be out and about, you can be on your life, doing your life, but available. It's kind of a good blend and flexibility. People have more flexible lives. They can pick up their kids at soccer practice, but still be plugged in, answer emails if it's during work hours. So we just have to kind of weigh the pros and the cons, and I think just shut it off at certain times, particularly when you're playing golf or on the weekend, or certainly in bed. Maybe get a White Lotus box outside your bedroom door and you drop the phone in before you go.
I'm zooming back over $1 trillion in market value, with the stock rallying to its highest level since February. I just want to get your take, final thoughts. You were very optimistic, glass half full on this market. You think we continue to rally from here?
I think we're going to get some follow through in the next few days. I think everyone's going to come into the market finally. All the holdouts, all the people short covering, they're going to chase up. And then we'll get some consolidation probably a few days out, some sideways grind, maybe a few percent pullback just to punish the Johnny-come-latelys. And then we push to new highs. I don't know if that's in a couple of months or 3 or 4, but that's the trajectory that we're on for sure.
All right.
And we're back. And by the way, I want to thank Madison Murtaugh and Cassie Loloff for having me on the show, in addition to obviously Taylor, Brian, Jackie, and Dagan. Then I had the chance to join Kristen Scholler. Want to thank Kristen and Mel Montanez. We're going to listen in here.
Joining me now to talk more about these markets amid some very busy overnight action, including, at least in temporary, trade deal between the U.S. and China, is Thomas Hayes. He's a chair and managing member at Grey Hill Capital. Thomas, always great to have you on the show. I think last time you joined us, you were pretty bullish, and since then we've seen the S&P 500 rise. What do you make of this deal and where it puts us for equities?
This is a landmark deal. This is a landmark morning. Particularly, here's the phrase of the day: trapped bears, okay? We had record selling. $1.1 trillion was sold at the absolute lows in early April by hedge funds and CTAs. Now they're forced to cover, they're forced buyers, they're forced to chase up. You couple that with record amounts of buyback announcements, $665 billion of buybacks announced. These guys are in trouble, okay? Let's just put it that way as they chase up. So I think we're going to get some follow through for the next few days. Once everyone gets in the boat 3-4 days from now, we probably start to get a little bit of consolidation, a little bit of pullback for the Johnny-come-latelys. That's just the way it always works.
Yeah. So what does this tell us? Has it been a change in true direction, or is this still a very dynamic trading market?
Yeah, it's interesting. I look at earnings, and earnings in the face of all of this uncertainty and all the, let's be candid, chaos that was going on for a couple of months, came in so much better than expected. 13.4% versus 6% estimated, with 90% recorded. Then you look at the guidance. Estimates didn't come down that much. They came down from 270 to 265, 3.6% reduction. But 2026 held up at $300, which means we're only trading at 18.5 times compared to 18.3 times for the last 10-year average. So there's a lot to do. I think you got to really start to look at the things that were hit hardest by tariffs are going to be the greatest recovery opportunities.
And already we're seeing some of these semiconductors, technology names, riskier stocks, ones with a higher beta, certainly ones that sold up dramatically. I think the semiconductor index at one point was down 40% in that April 2nd announcement. Those seem to be the ones coming back the most. Is that what you see?
I think so. The other thing I'm looking at is cyclicals relative to defensives is at a record all-time low positioning. So cyclicals, we start to look at consumer discretionary, we start to look at industrials, we start to look at materials. Maybe you even start to look a little bit over at energy, because you noted this morning that the S&P was up a certain percent, the Dow was up a certain percent.
Yep.
You know what was up more than all of them? Russell Small Cap Index. Largest short interest on record. So if the game is on, is really what it comes down to. And I think you'll see it in the indices for sure. But there are so many stocks that are still down 50%, 60%, 70% that are great businesses that have been around for decades that are going to start to fly. Interesting.
Other particular stocks on your radar?
Yeah. Disney, we came out publicly like 3-4 weeks ago. It was a no-brainer. We said, buy Disney at $85. Of course, the next few days it went down to like $82 because that's what always happens. But now it's at $108. It's going to continue to climb over the next 2 years, probably over 200 in our view. All of their segments are growing at mid-teens, double digits. They just put guidance out for $17 billion of cash from operations this year. So this is a well-run business. 180 million streaming subscribers. They grew 2.5 million. So there's a lot of good things happen there. They'll continue to invest. We saw the park in Abu Dhabi. They'll continue to invest in the cruise ships, which have a very high return on invested capital, like mid-20s return on invested capital. So that business is going to continue to grow. And then the second one I have, no one is going to buy when I put out this name. They're all going to say this guy's crazy. And then a year from now, we're going to be back on and be like, do you remember last year? It's called Albemarle. It's the #1 lithium producer. Positioning for materials. Materials is going to have the highest earnings growth, second highest earnings growth in 2026. You're getting positioned ahead of time. Lithium is in a glut. Everyone thinks EVs are done, except for the fact the U.S. is 10% of the market. China is 60% of the market. It's not a natural market. It is a subsidized market. It is policy initiative. They grew EV sales 38% last month. Albemarle is the lowest cost producer. They've got these mines in Chile, and they've got $3.1 billion of liquidity to ride this out. So as all the smaller players go out of business, as prices are down, that shrinks supply. Albemarle is left standing, and the operating leverage is huge. This one, we talked about Disney going up, whatever it was, a double plus. Yep. from this thing can go up a lot more than that over the next 3 to 5 years as the market. Demand for lithium from 1.2 million metric tons today to 3.2 just in 5 years. And so we're not looking at a triple, because the operating leverage in that business could be a lot more than that. So that's a good one. It's a long-term one. Yeah. It's $61 today. I'm sure it'll go to $55 tomorrow. But a year from now, it's going to be a lot higher. I can tell you that right now.
And now, where's the demand coming from, Thomas? You see it around the world or specifically in China?
Predominantly China. Also, it is going to be around the world because it is a cyclical thing, but also energy storage is a big component to this. It's not just EVs. And as you need more and more of these devices, and you need, the demand is unlimited for this. And the tariffs really hit it. The glut in the cycle really hit it. But you know what? If you look at the long-term chart, this happens every 3 to 5 years for Albemarle. It happens every 3 to 5 years for lithium. They have a few other businesses that'll support them through this. Yeah. But they'll be the last man standing, and they'll reap all the benefits as we recover.
It's interesting. It's obvious, right, based on the market observations, that we can see that the president is able to move the markets with his commentary and changes in policy. There's one other factor, though, and that's the Federal Reserve and how it decides to respond to these policy changes, as well as some of the economic data that we'll get this week. What does that mean for the markets? The fact that the latest indication from Jerome Powell is that he is going to take his time.
Yeah, it's interesting. I was thinking about that on the way down here. I was pretty certain we were going to have 2 cuts this year at the back half of the year. Moving forward, if this continues in the same vein, I think 1 cut. We're probably still going to wind up with 2 cuts because we'll get this initial high, and then we're going to say, well, you know what, there was some short-term damage done to small businesses. It's going to take them a couple quarters to recover. So I think 1 to 2 is still a safe bet this year. I think Bessen's working on the long end of the curve, which is more important as it relates to housing, as it relates to refinancing the debt. So all in all, very sanguine here, and pleased to see this. It did come a bit sooner than we expected, so we're not arguing about that. That's for sure.
All right, Thomas Hayes is a chair and managing member at Gray Hill Capital, joining me in studio on a very busy market day. Thank you so much, Thomas.
Thanks for having me, Kristen. And we're back, and finally we joined Diane King Hall. Want to thank Heidi Schultz and Allie Thompson for having me on. We'll listen in now.
Joined by Tom Hayes, Chairman and Managing Member, Great Hill Capital. Tom, thank you so much for joining us today. Let's start out with this 90-day pause that we're getting between the U.S. and China. I think this caught a lot of people by surprise because many I talked to weren't expecting to see this fast. What's your reaction?
Yeah, we expected resolution. We didn't expect it this quickly. It's unreal. And right now, it's exacerbated by the fact that the phrase of the day is called trapped bears, okay? We had record selling by hedge funds and CTAs at the absolute low in early April. So now the market's come so far so fast, even before today, and they were praying for a retest of the lows that never came. So now they've got to buy up. They're forced buyers. They're forced covering. So this could probably get some continuation, some follow through for the next few days because so many people are structurally off sides.
So what are you expecting now? Because yes, you made the point about trapped bears before we had any deal on the table between the U.S. and China, and all we had on the table was the framework of a deal between the U.S. and UK. So you call them the trapped bears. How do you see this forced buyer dynamic playing out?
Well, they got to catch up. And what's interesting is who's been buying from these trap bears. We have a record amount of announced buybacks from companies, $665 billion. So they're buying. These poor guys are trying to cover their shorts, trying to catch up, trying to chase up the rally. So my guess is this is going to continue for a few days. They're going to force them in after a huge move off the bottom, even before today. And then we'll probably get a little bit of volatility as people digest, like, oh, we've got 90 days, et cetera, et cetera. So expect a little short-term material follow-through, but it's very interesting. On April 7th or April 8th, Trump went out on Truth or Twitter or whatever.
Social media platforms.
And he said, now's the time to buy stocks. And no one believed him. And the next day, the market went up. Last week, he did the exact same thing when people were getting pessimistic before the UK deal. And he said, America is going to boom. And he also referenced stocks. So if they say, you know, everyone's looking for the Fed put and the Treasury put, the Trump put is real. He's paying attention. He listens to people. And why we were optimistic and why we were positioned for this, not to happen so soon, but positioned for this to happen eventually, is because he's shown, and the administration has shown, flexibility and rationality throughout this process. He genuinely does want to negotiate better deals. And if you remember the first term, the people with assets like me that manage money, we did okay. It was a good 4 years. The everyday people that work every day, the middle class, the lower middle class, they did better than ever during those 4 years. And that's what President Trump wants to see. And it's deals like this and initiatives like this that is going to create that. You won't see it in a week, but over the next few months and couple years, you're going to start to see that middle class boom.
We have seen more flexibility come to pass than we initially saw at the beginning of April. But I do wonder if some of that is because of the leadership shift that we saw with essentially the Treasury Secretary with Bessent leading versus Navarro.
They did put Navarro in the closet for a few weeks, which was, you know, a welcome reprieve by yours included. However, I will say, Lutnick did get the job done with the UK, and that kind of paved the way for positive talks with Bessent over the weekend. So I got to give credit where credit's due, and President Trump has made no bones about it. He wants to be recognized as one of the greatest presidents in history. If stuff like this continues to happen, and him cleaning up messes that have been going on for decades, I'm not blaming any one administration, Republican administrations, Democratic administrations, neglected to do this. If he cleans this up, he's got a shot at his goal for sure.
Okay, and let's talk about, you mentioned the buybacks at record levels. So how important is that in terms of driving momentum?
Well, there's no question. You've got CTAs and hedge funds covering, now chasing up, now $665 billion of buyback announcements. Oh, and by the way, earnings, in the face of all of this uncertainty and craziness, earnings came in much better than expected. 13.4% earnings growth versus 6% estimates. And the forward guidance hasn't come down that much for 2020.
Some of them have, and then some haven't even given guidance.
Yeah, fair. But listen, let's look at S&P earnings for 2025. Came down to, basically from 270 to 265, about 3.5% since the beginning of the year. That's pretty material. However, 2026, back-end loaded, still $300 a share of earnings, which implies we're trading at about 18.5 times compared to the 10-year average of 18.3.
Okay.
There's still things to do.
And then, so speaking of things to do, I know you have some picks. You like Disney. Tell us about your thesis there, and if you still like it.
Yeah, it's interesting. We were pounding the table publicly for Disney. It got down to like 85, and then after we went out, buy it at 85, I think it went to like 83 or 81, of course.
Yeah.
And now it's at 108. We think over the next 2 years, this is a $200 stock. They're hitting on all cylinders, whether it's the parks, whether it's the cruise experience, whether it's the consumer products. And they just guided. They said, we're going to do $17 billion of cash from operations this year. That shit, and by the way, 180 million subscribers. They're second to Netflix. Yeah. They added 2.5 million. They're going to do this ESPN. Their sports business is through the roof. So we continue to like it, despite the fact it's moved up so much in the last few weeks.
And the Abu Dhabi.
Yeah, that doesn't hurt either. Yeah.
And what else is on your list?
Here's one that no one's going to want to buy. Albemarle. Okay, this is okay.
Tell me about this one.
Yeah, you know me. I'm early, and people like.
You do like. There are sometimes some picks on your list. I'm like, huh?
And then a year later, we sit down. And you're like, oh, that was pretty good.
Yeah.
All right. So Albemarle, #1 lithium producer, also lowest cost lithium producer. Lithium prices are in the garbage. Why? Because everyone says EVs are out of favor. Blah blah blah. China is 60% of the EV business. It's not a natural market. It's a government-subsidized market. They have an initiative. They're going to continue to grow. They grew EV sales 38% last month in China. So what's going to happen? As one of the biggest producers, you just wait it out. Lithium prices are very cyclical. Every few years, they go up and down. We're at the trough right now. They've got $3.1 billion of liquidity to sit it out. All the small players will go out of business. That shrinks supply. Demand continues to go up. And energy storage is a big thing. Overall demand from 1.2 million metric tons right now to 3.2 in the next 5 years. Albemarle, we talk about Disney going up to 200. Albemarle could be a triple over the next 3 to 5 years.
Really? Okay.
Yes.
Because we just threw up a chart, and you mentioned the trough of, I don't know if they're going to pull it back up again, but we just threw up a chart, and you mentioned the trough of lithium. The chart looks like that for Albemarle.
I'm going to tell you something right now. It's at $61.
We'll look at it. Yes.
It's going to go, let's say, it's going to go, right after I get off the air, it'll probably go to $55. Everyone will say, that guy's an idiot. A year and a half from now, you're going to have me on, Diane, and the thing's going to be over 100, probably closer to 150.
Okay, all right, you heard it here first. That's Tom Hayes, Chairman and Managing Member of Great Hill Capital. Our thanks to Tom.
And we're back. Quotes of the week: the biggest mistake investors make is to believe that what happened in the recent past is likely to persist. That's Ray Dalio. That's called recency bias. We cover it very frequently on the show. Here's my mug from my friends down in Dallas. They know how to make mugs. We're going to make better and better stuff, different stuff all the time. We'll throw in some new stuff every now and then. But I always like to get the founding gear. Seth Klarman, the stock market is a story of cycles and the human behavior that is responsible for overreactions in both directions. Oh, and by the way, I want to acknowledge the new clients who came in. We open up once a quarter for the small accounts, the $1 million accounts, the minimum accounts, and then the people that are doing the bigger accounts, they can come in whenever they want, and we've had a couple of those come in the last week, so very grateful for that, and welcome to the family. Okay, Seth Klarman, stock market story of cycles and human behavior that's responsible overreactions in both directions. And when we did that special call for clients on April 7th or 8th, whatever it was, the day before Trump tweeted, now's a great time to buy stocks. We went through that and we said, listen, look at the revenues, look at the free cash flow, look at the balance sheet. And we went company by company by company. And we said, if there was ever a time, we've never asked, number one, we've never asked anyone to invest. Okay. People come to us that listen to the podcast or come from referrals of people, et cetera. Number two, we've never asked existing clients to put in more money. They put in more money as they get more money as we deliver results. That's the way it works. But we did do it twice. We did it in October 2022, and the people that took advantage of that, we crushed it, okay, because they were throwing Amazon out. They were everything was getting thrown out with the bathwater. Amazon and Google were quick doubles in a year. And then the last time we did it was just 4 weeks ago. And I was on April 11th on Varney talking Disney at 85, and Boeing. Boeing had already moved up. We were pounding the table before that, but it was like 154. Both of them are up 30% in the last 3 weeks. Since then, it's unbelievable. Warren Buffett, the most important quality of an investor is temperament, not intellect, and that's where we make our money, is taking advantage of dislocation, whether market, which was the case 4 weeks ago, sector, which is what we do on a regular basis, or individual company, high-quality companies when they're temporarily impaired, and rinse and repeat over and over again. GXO, now getting to our data charts. GXO welcomes, there we go, 5 new members to its board of directors. Brad Jacobs put this out on LinkedIn today, and I noted the most important part. These leaders bring deep expertise in operational excellence and strategic growth across all aspects of the supply chain. They will add immediate value as GXO, quote, accelerates its path to becoming the world's leading logistics provider, ladies and gentlemen. Numero uno, the big kahuna. That is in a public release that they're stating their intention. And I commented in Brad's post, I said, you don't attract this quality of directors if the turnaround plan is not clear. These type of people are not going to put their reputations on the line for a sinking ship. Todd Cooper, you can go through all of these, whether it's Chief Product Supply Officer from Procter & Gamble, whether it's the Chief Supply Chain Officer at Honeywell International, whether it's the Chief Financial Officer from XBO Logistics. I mean, on and on and on. And then we've got our RBC stuff, Slumer. You can see the quick recovery we've had, V-shaped recovery so far, with, by the way, momentum kind of just turning, which is also pretty surprising. So you can kind of see where we are now. This is an area where you would normally find a little consolidation and a little bit of rest, but if the deal things keep climbing across the tape and you got all these trapped bears that we talked about, you don't want to be uninvested. That's what I can tell you right now. I mean, even if you get a 3-4% pullback to knock out the Johnny-come-latelys before we push forward to new highs, just hang tight. It's pretty exciting. You're seeing the advanced decline line, and breadth is very, very strong as it broke out above this. Sometimes you see these breakouts and then a back test before you go to new highs. So just be aware of that. Don't worry about it. Small caps just getting started. Short interest at a record high. Super excited about this group. And by the way, those were the biggest movers yesterday. Bullish and bearish sentiment survey, still super bearish, but starting to slowly move bullish off of super extreme like you saw in the great financial crisis after the lows, which is pretty exciting. MSCI Europe, you can see here starting to move. DAX is already at new highs, broke out. I mean, this is the international relative to U.S. story that we came into the year strong, pounding the table on. That's playing out in real time. You probably get a short-term counter trend of that maybe with the DAX go back and retest. U.S. continued strength. Hang Seng just getting started in its recovery. Super excited about Alibaba. They're going to report this week, by the way. So 10-year yield trading in this range. This is going lower. Pay attention. Google SLR, Besant, and you will see what's going to take place in the second half of this year when they change capital requirements and government guaranteed securities like treasuries are exempt from capital requirements, which means they're going to be able to hold a lot more, which means they're going to be buying, banks are going to be able to buy a ton of treasuries, and they're the way they're structured, they buy the short end of the curve, but what that will enable the Fed to do is, the Treasury to do is Operation Twist, where they can sell short term and use the proceeds to buy long term to bring down the long end of the curve, which helps, most importantly, mortgage rates, followed by auto rates to some extent, and brings down the refinancing cost for the country, because if we can issue unlimited short term to banks and they can earn. Then we can buy in the long end of the curve, bring that down, refinance the long end of the curve at low rates, and push out the maturities, which is really what we want to do. Difference between U.S. power demand growth and U.S. GDP flipped with latest data. So you can see power demand is turning up. That's what you see when GDP goes up. So you can see that this was a fake out of inventory pull forwards. 10-year yield, the counter trend move that we talked about. Maybe it goes back up to 583 before going into the threes. I wouldn't hold your breath, but it's certainly possible. 450, 458 level, maybe. Dollar index, this is the counter trend move that we called for 2 weeks ago. Here it is. Maybe goes up to the back of this uptrend channel and then breaks back down. It's kind of comical talking about all this technical stuff. It absolutely plays no real role in what we do in buying great companies, but people like it. Give the people what they want. Gold rolling over here as the dollar has a counter trend move. This is interesting from Strategas. Great shop there for research. They've got 20-day highs through 50%, the first time since late 2023. And when you have percentage of stocks at a 20-day high that goes through 50%, it tends to be a sign of immense strength, and the rally tends to follow through pretty dramatically, even if you get a short-term check back before you power higher. And he goes all the way back, and he shows all these instances recently in 2023, 2022. Then he goes back to 2020. And shows what happened when that type of stuff happens coming out of COVID. Then he shows it in 2018 coming out of the first Powell mishap. Then he shows it in 2015. And these are all follow-through rallies. Then he goes back to 2008 to 2013, how it worked pretty much every single time. Then he shows 1972 to 1983. So this is an interesting indicator. Even if the market's moved a lot, when these extremes happen, it means there's strength behind it. And even if you get short-term checkbacks, it tends to precede big rallies. U.S. is 64% of global equity market versus 61% average of the 2020s. It hasn't been this high. You got to go all the way back to June of 2003 when it peaked at 55% of global equities. And that's one of the indicators pointing to the theme that we've been talking about when it was unpopular, that international would outperform U.S., and it's dramatically outperformed this year. And that trend will continue, I think, for the foreseeable future, next handful of years. That doesn't mean the U.S. is going to do poorly. What it means is that pockets of international will outperform, even if the U.S. does okay, which we believe it certainly will. And then you've got China PBOC cutting rates. By the way, global M2 money supply is booming, which means liquidity is coming into the market, and largely it's coming from China. China was a source of illiquidity for 3 years, draining liquidity. Now they are a source of expanding liquidity from all their stimulative practices and easing. So this is going to be a positive thing, not only for China, but for the rest of the world. They're finally picking up the baton that the Western world ran with during COVID and afterward. Now they are picking up the charge moving forward. So here's the asset quilt of total returns. You can see EFA is dramatically outperforming. EFA's positive. S&P was negative. It might be positive or flat on the year after today. Emerging markets is outperforming. All the things that we said. If you go back to the fourth quarter, I said the last shall be first, international, etc. And S&P is towards the lowest. International is towards the highest. And there you go. Dollar faces a secular decline, so you'll get these counter trend moves, but we know the trend is down in the intermediate term. 1 month since the bottom, had a bounce in tech, industrials, consumer discretionary, financials, real estate, etc. have done very well. Biggest 4-week outflow from U.S. stocks since May of 2023. Biggest tech outflow in 11 weeks. So that's in the last week or so. Consumers' momentum remains. So this is the difference between hard and soft data. They say they're miserable, but they keep spending money. Then we look at auto SAR for April was 17.3 million, ladies and gentlemen. So obviously a little bit pull forward with the tariffs, but now we got to replenish the destocking cycle, and there are going to be incentives for car owners, and you've got a 13.5-year average car on the road. A lot of things going on here. So if this 17 plus can continue, we're going to continue to see extraordinary things from Cooper Standard. Okay, I wouldn't expect this to be a straight line, but look at where the trend is going. Just like every single recovery, which was our thesis from day one when we put on that first huge position at $5 and change in May of 2022 and went on the claim and countdown on June 6th and pitched the stock. And here we are, 5x so far and just getting started. We think this can be a multi-bagger even from these levels. International versus U.S. stocks. Rolling 4-month performance spread. So international is outperforming U.S. by 16.2%, ladies and gentlemen. The last time you saw that spike was the early 2000s, and that trend continued for 5 years. It was one of the biggest periods of international outperformance over U.S., and that's that. Number of consecutive weeks with AAII bears above 50% was 11 weeks. You haven't seen that since the early 90s. You had an 8-year bull market after that, and since the great financial crisis, and you had a multi-year bull market after that. AAII asset allocation, lowest equity exposure since October 2023. That was a time to be a buyer, not a seller. Global monetary stimulus is going through the roof. This is the 3-month sum net number of rate cuts globally going up. What follows that? Global manufacturing PMIs, they're down here on the mat. They are going to spike up. Firms plan to pass tariff-related costs to consumers. Okay, well, now the tariffs are a lot less than advertised, so it's going to be less of a story. U.S. companies buying back stock at a record pace. Most announced buybacks in more than a decade, $665 billion in the first quarter of 2025. Watch what people do, not what they say. Best 1-month return since 2020 off the COVID lows. That was the best year. Unbelievable year. Rallies of this magnitude often have legs. 1-month rolling returns of these levels greater than 14% is often carried on with a forward 12-month return of 25% on average and positive 95% of the time since 1978. 56 instances. Average return after a month like that is 6-month return is like 14%. 12-month return is 25%. How you doing? It's going to be a fun time. So as Varney called me the resident bull, I'll be willing to carry that title for some time to come. Average U.S. gasoline price ahead of peak demand season. EPS revision tracking near historical pattern, a little bit better than historical pattern. Announced buybacks versus actual, so there's a lot of catch up here. There's a further bid in the market. PBOC stimulus we continue to cover. Active listings relative to the start of the year from Realtor.com. They're picking up. Supplies coming on. That's good to see. Germany expected to inject up to $1 trillion into the military and infrastructure. Okay, that's a lot of pressure from Trump. That's good. University of Michigan, consumer confidence. At points like this, when it's so flushed out, they tend to precede very good things in the equity markets. Companies are maintaining guidance more than usual. And that's one point that I've made, despite all the uncertainty, the fact that this year only came down 3.6% and next year has held up. Now that you see a lot of the tariffs coming down to 10% from these astronomical levels, I think we're going to just see guidance start to go back up and people are going to get excited. Retail investors at lower levels than 2019. Net inflows to U.S. versus Europe. Systematic positioning in U.S. equities. This is what we've been talking about with regard to the CTAs and hedge funds. They haven't sold this much in the hole, been this short since the COVID lows, and they missed, what was like a 90% rally thereafter. And I think the same thing is happening right now. What was forced sellers is now going to be forced buyers, every positive headline. So these type of opportunities don't come around that often, ladies and gentlemen. Institutional position in S&P 500, asset manager positioning well below. The market's taken off without them. They are going to have to chase up just like every single time. Some potentially good news. S&P drops 10% in 2 days. When did he publish that? Anyway, 12 months later, the S&P's up 32.6%. So we saw that in April. Here's the reciprocal tariffs, China's retaliatory tariffs, and now back down. So it went up to 145.25. Now it's down to 30.10, which is a good place for it. ETF float. By the way, the big story, and my friend Jerry actually emailed me about this, who I met in Hawaii. He said the biggest thing, and this is a guy who ran one of the greatest banks of all time, U.S. Bank, and he said the biggest thing is the opening of China to U.S. businesses. It's not the tariff rate. And if they get these non-tariff barriers removed, it is going to be boom time. I've said in past podcasts, $1.1 trillion of S&P revenues comes from China, from the S&P 500. So if they open up more to U.S. businesses, this is going to be a boom for China, a boom for the U.S. like we've never seen before. Our ETF flow tracker suggests national team has been buying to support the market in China. So you can see cumulative flows to the top 5 NT holding A-share ETFs, net buyers. So the Chinese government is propping up the market until it takes on a life of its own. So they're in the game. They went from asleep at the wheel to in 5th gear, and that's going to be a great thing. 2025 earnings growth estimates, emerging markets, 10.4% versus the U.S. at 7.1%. Much lower multiple, much higher growth. Where do you want to be? NASDAQ 100 re-enters bull market, so now it's up 20% after shortest bear market in history, I guess. Broadening, other than COVID, broadening breadth, equal weighted S&P 500 beats main index for 6 straight sessions. That means under the surface is what's making money, and the clients can see it in their P&Ls. I mean, it's unbelievable. When we saw BABA take off in January, February, it was like, oh my gosh, it's like through the roof. And now it's better than where we beyond overtook our high water mark. And it's from the first quarter, which is just awesome. I mean, and the market's not even recovered yet, which is even more awesome. So super exciting times. Broadening breadth, equal weighted, got that. Next, realized and consensus EPS growth for select U.S. indices. So you see the Russell 2000 has the biggest growth rate, small caps, record short interest, and biggest earnings growth for this year and next year relative to mid cap, relative to NASDAQ, relative to equal weight, relative to S&P. Highest earnings growth, lowest multiple. Get your small caps, ladies and gentlemen, because those shorts, I talked about MOAS, mother of all short squeezes this morning on Varney with regard to the market. Forced sellers became forced buyers. It's going to be nothing compared to what you're going to see in small caps. There's going to be some face-ripping rallies in small caps. Mark my words. You can count on that. Can stocks get back to positive in 2025? There's no question about it. There's no question about it. U.S. inflation rate is lower than it was in September when they did an emergency 50 basis point cut. Fed's too restrictive. They're going to wake up. They no longer have the tariff excuse because the tariffs have come down. They've got to get in action and remove the restriction and let people buy homes and cars and get on with their lives. Versus screw a bunch of millennials who want to buy houses because you want a plaque that says, I'm not Arthur Burns. The gap between U.S. hard and soft data growth is among the largest in since the 1970s. We've covered this. People are super pessimistic, but they're still shopping like there's no tomorrow. That continues. Fund manager equity allocation, lowest since May 2023. All these people have to chase up now. They all have career risk. They missed it. They sold in the hole, 1.1 trillion. Now they got to buy up, and they're going to be forced in at new highs. The story just continues to repeat. Long gold is the most crowded trade in the fund manager survey. That's going to be over sooner rather than later. I know no one believes me, but hang tight. Earnings sentiment has now come back up in the S&P 500 like a hockey stick, so that's good to see. Mag 7 has lagged the rest of the market year to date. That continues to be the case. S&P 493 are up 1%. S&P was down 3%. This was a couple of days ago, and the Mag 7 down 12%. That was a theme coming into 2024-5. Go back at the tapes. Was Mag 7 will dramatically underperform. International will dramatically outperform. Both of those have held true. Goldman's positioning indicator, deeply negative territory, suggests there's room for stocks to rally. We agree. What is this? Oh, this just shows S&P stocks above the 20-day, 50-day, and 200-day moving average. So the 200 has got plenty of room to run here. The S&P just overtook the 200 moving average. Take it for what it's worth. VIX below 20 is another clue. The worst is over. 12 months out, median return 10.3%. Advanced decline line continues to climb. Hits record high for the first time in 100 days. 1 year later, average market's up 14.21%. Total US dollar futures positioning is getting shorter. So probably we have this counter trend rally go a bit lower first before getting a bigger bounce. We'll see what happens. We'll pay attention to the commitment of traders reports. As stocks continue to claw back potential all-time highs, remember that only twice in the past 75 years did stocks peak in February. Stocks tend to peak in December or January, according to this Carson data. Chart of the day, better than expected 1Q earnings. They were expected to be 6%. They came in at 13.4%. S&P has surged since Trump said great time to buy. It surged by 14% since that tweet. And by pure, well, it wasn't luck, because I've just done this so many times. I could tell we were at a peak crescendo of fear. And that's why I chose that day to do it. And then sure enough, that was the inflection. Which is very similar to the COVID lows when I got quoted in that article in Market Watch saying we are buying during the 1918 Spanish flu. The Dow was down 35%. We're down 33%. We don't know what's going to happen, but with all these great companies marked down, we're buying high quality businesses. 2 days later, the market bottomed and never looked back. S&P 500 rebound is one of the biggest under Trump era. CTA positioning, again, this is what we've been talking about. They are forced buyers for the foreseeable future. There'll be a few fits and starts. Climate-related spending, 12-month moving average by type. So you can see government spending is going down. Premiums after loss, power outages, etc. All right, moving on to the next. U.S. and China agree to slash tariffs for 90 days in major trade breakthrough. That was just awesome. JD grows the fastest since 2022 amid contest with Meituan. So that's cool to see. Their earnings were better than expected. China removes ban on Boeing deliveries after trade truce. I wonder if they still have their position in line or they got to stick with Comac. Something tells me Boeing will let them back in the door. Alibaba stock soars. It's not just the tariff pause. You can read all about the AI. And Joe Tsai highlighted the importance of artificial intelligence would be, quote, key driver of company's operation in the next 3 to 5 years. Every business of Alibaba will closely integrate with AI, as the company believes with AI application, not only does it help optimizing search recommendation, it could also create and define new user entrances in different services. New Alibaba method slashes costs of training AI search by 88%. Let me repeat that. New Alibaba method slashed costs of training AI for search by 88%. The Chinese tech giant has introduced a way to train AI models without constantly connecting to external search engines. Look, they are going to be the leader in AI. They are certainly the leader in terms of value per dollar, in terms of having a piece of all the AI startups in China, and in terms of their models outperforming DeepSeek, OpenAI, and all the others. Hedge funds re-enter Chinese equities on trade talk optimism, Morgan Stanley says. Morgan Stanley, by the way, was the firm who downgraded Alibaba at $64. Just FYI. AI will be the mainstay of Alibaba's business in the next 3 to 5 years, Chairman Joe Tsai says. S&P 500 has jumped 14% since Trump said, quote, great time to buy. CTAs now buyers of every scenario as buybacks accelerate and bearish funds capitulate. Small caps soar on the U.S.-China trade deal. They can rally a whole lot more. That is from Jacob Sonnenschein. Great article there. Good observation. Goodbye, EV tax credit. Hello, aid for buyers of U.S.-made cars. Some details of President Trump's so-called big, beautiful tax bill are out. Now, automobile investors have two matters to consider: the possibility that electric vehicle tax credits could vanish and the potential for a new tax break on cars assembled in the U.S. House Ways and Means Committee set to release so-called markup details of the budget reconciliation bill. Beautiful bill. Details have emerged. Repeal of EV tax credits. Consumer credits will be repealed almost immediately, while business tax credits will be phased out. Right now, consumers can claim a deduction. Just created a leasing loophole. Looks like commercial gradual phase out. A new tax break for American assembled cars is also part of the initial market. Essentially, car buyers could deduct interest on auto loans from their taxable income if the car was made in America. Boom shakalaka, ladies and gentlemen. I mean, what this will do to volumes for Cooper Standard will be through the roof. Let's see if it finally gets through. He talked about it in the campaign. Let's see if he can deliver. Americans hit the road as economic fears discourage flying. Run those 13-and-a-half-year-old cars to the ground. Cooper Standard will help you buy your new one by creating the sealing systems and the fluid transfer systems better than anyone else. Volume, baby, volume. 17.3 million SAR in April. You can't, I mean, it doesn't get any better. It's going to get any better, that's for sure. Why JP Morgan says the U.S. lag versus European stocks is just beginning. We actually agree with the sell side. Why the Fed should be easing even in the face of tariffs. Covered it on Varney Co. Extreme heat risks, summer power shortages, warns of largest U.S. grid. Who's that good for? Generac, baby. Number one in the home standby generator penetration, just getting started. The states that have the highest penetration also have the highest growth rates. When your neighbor gets one and the power goes out and they're watching TV and you're in the driveway sweating in your car, the next time you have a generator too, and Generac is the only game in town. The only material buyer of this dip was Mr. and Mrs. Retail. Goldman Macro Trader sees path to real market tailwinds. All the super sophisticated, short, bearish morons now have to chase up and buy the scraps. Corporate share buybacks were a shock absorber in April's sell-off. They're going to continue to accelerate. Article of the week, the magic's still there. Stock market and sentiment results. We covered all the media. Let's get to the stocks. Disney update. You can see here cash flow continues to explode off the charts. Basically back to record highs. Revenues at record highs. Margins are starting to reaccelerate again. Return on capital is reaccelerating again. Pretty much every single unit was up. Revenues were up 7%. Free cash flow more than doubled. They guided $17 billion of cash from operations this year. 180 million subscribers. They added 2.5 million subscribers. They're opening the park in Abu Dhabi. I mean, it just goes on. And this one's going to be a $200 stock. It's just a matter of time. So no one wanted it at 85. Everyone will want it at 150 to 180. And people will be naming their dog after Disney when it hits 200. So turbocharged investment in experiences, $30 billion in domestic parks has led to more expansion projects underway globally than at any point in Disney's history. Strong film slate coming. High margin accretive cruise business, which we talked about, the highest return on capital of the whole entire product suite. Streaming, cooking, profitable, becoming more and more profitable. Disney parks, main driver of EBIT, continued to see strong attendance. $6.5 billion in revenues, up 9% year on year, 13% up in EBIT. So this continues to go. Viewership was up 32% year on year with ESPN. You can't make this stuff up. Advertising market remains healthy. ESPN posting over 20% ad growth in the quarter. Operating cash flow expected to be $17 billion. Management raised guidance. What else do you want to talk about, ladies and gentlemen? I mean, this is easy. These things you don't have to think about. You don't have to stay up at night thinking about, should I buy Boeing at $130? Should I buy Disney at $85? These are no-brainers. And the problem is, there's two ways to interpret the word no-brainer. And the people that pass on these opportunities, no comment. All right, so moving along. GXO. So, look, prices followed cash flow. There's no accident about that. We saw they got the new board members. These guys aren't coming on because they think the company's going to fail. They're coming on because they know it's going to be the best logistics company in the world, and they're taking advantage of the weakness in the market to cobble up. The CMA decision is going to be finished. First off, increased first quarter revenue was plus 21% year over year to $3 billion. Organic revenue grew 3%. Sales pipeline to three-year high of $2.5 billion. That's excluding the Winketon business, which is under the CMA review after the fact. They also repurchased almost 3 million shares, 2.8 million, reaffirmed full-year organic revenue growth and adjusted EBITDA guidance. Okay. They have Boeing as a client, by the way. That's pretty cool. New win. Aldi, Kimberly-Clark, Nike, ASOS. Cash flow, operating cash flow was $29 million. Free cash flow is negative, but that's normal this time of year. So let's cover the key points. Sales pipeline, 3-year high at $2.5 billion, up 13% year on year. Winketon and CMA review process is now in its final stages with an outcome expected in a few weeks. And integration set to begin before the Q2 earnings call. Management expects either full clearance, which would be $10 in the stock, maybe $20, of the deal, or a request to divest the grocery business, which makes up only about 6% of the original Winketon business and has much lower margins than the overall business. Management continues to expect $58 million in cost synergies once integrated, providing a margin tailwind as 2025 progresses. After announcing a $500 million share repurchase $5 billion share repurchase program earlier in the year, management purchased 500 million, put billion, purchased 2.8 million shares for around 110 million. This reduced the share count by approximately 2.4%. In this quarter alone, if sustained, GXO is on track to repurchase about 10% of the overall float this year, which means you get a 10% larger slice of the pie without putting out one new penny. GXO signed a landmark 10-year deal with England's National Health Service supply chain, the largest contract on record with a lifetime value of around $2.5 billion. Operations are expected to begin in early Q3. Management doesn't anticipate significant startup costs and expects the deal to be a major catalyst for expansion into healthcare, with a strong new pipeline of healthcare-related customers expected to be announced in Q2. Surprise, surprise, why do you think all these directors are coming on board? Management reaffirmed the 2025 outlook, expecting organic revenue growth of 3 to 6%, EBITDA $840 to $860 million. Normal operating environment. These results would have had led to an increase in the full-year outlook. To put this in context, management is projecting an 8% gross organic wins for the year. And in Q1 alone, they booked $228 million, delivering about 7% organic growth. This essentially implies no incremental wins contributing to revenue for the rest of the year, despite an all-time high sales pipeline at $2.5 billion and the landmark NHS deal. Welcome to Sandbagger City. 6, management has seen no material impact on the sales pipeline or customer demand due to tariffs and has no exposure to China. In fact, the added complexity of tariffs has provided a tailwind for outsourcing wins, highlighted by a 41% increase in wins during Q1. 7, operating return on invested capital was 45%, well ahead of the long-term target of 30%. Free cash flow is an outflow of $48 million, in line with normal seasonality and impacted by the delayed Wincanton synergies. Management continues to expect 25 to 35% of adjusted EBITDA to free cash flow conversion for the full year. So call it 250 of free cash flow. AI and automation are now live at 20 different operations, delivering record-setting productivity improvements in stock replenishment, order allocation, and item inspection. Management is beginning to see the first cost savings as a result and expects to see savings continue ramping through 2025. North America was the strongest region in Q1, driven by strength in aerospace, i.e. Boeing, and industrial customers. Continental Europe continues to perform well, with slight weakness in volumes in the UK during Q1, expected to rebound through Q2. Overall, business is seeing similar trends heading into Q2. Weaker dollar and strengthening euro and pound are expected to be a strong tailwind for GXO in 2026, with an improvement over prior FX guidance if current rates hold through 2025. They're going to get better. So that's that. You can go through the call. We've highlighted the important parts. And finally, Baxter update. Prices followed cash flow. There's no accident about that, but look what's happening to revenues. They're starting to recover. Return on capital is going up. Margins are going to improve from the cost cuts. Delevered the balance sheet, and moving forward to bigger and better things. You got to have a healthcare play. This is ours. This is going to be a good stock. You can go through the call, and you can go through the analyst reports here. Fair value, and this is in the midst of pessimism. Fair value is 60% higher. General, almost, it's actually more than 60%, 55, it's almost 100%. Fear and greed starting to tick up. National Association of Active Investment Managers starting to play catch up after the fact. Russell 2000 earnings up 1.53% in the last 60 days. Top 30 weights down 45 basis points for next year. S&P earnings, on the other hand, are down 93 basis points for this year, 122 basis points for next year. Normal during this time of year. And then the CPI inflation number came in lower than expected, lowest in 4 years. And now the Fed has no excuses with the tariffs. So with that said, let's get down to the Ask Me Anything questions. For those of you who don't stick around for Ask Me Anything, thank you for tuning in. We'll see you next week. For those of you who love the Ask Me Anything, here we go. Jinan Chen asks about United. I continue to keep an eye on that. I continue to do nothing. Same thing that as they ask every single week, but I think it's going to take some time. I should probably just stick an alert on this at $200 to $250. I don't know if we'll ever get it, but it's going to take some time. I mean, you basically got all these institutions completely just stuck in the stock. This thing has had a monster run, 60 bagger in, a decade. I think this is going to consolidate for a while. And I don't think it's a favorable environment for them, so I'm in no rush to do anything. Looks cheap relative to recency bias, but in absolute terms, it's run a lot. Do you still like Goose? Yes, I do. That was a tariff problem. They're going to be fine. China's coming back. We have no problem with that, Jake. We haven't added, but we're very, very comfortable with that. And GXO, absolutely, we've added, and we're very comfortable with that. GXO, no-brainer there. Mike Makos, we met at... Oh, wow. Okay, cool. Someone just invited me to play Arroyo Trabuco. That's a great course. The answer is yes. I'd love to join you. Richard, VST is buying back a ton of stock. Do you ever consider any name near new highs That likely goes much higher. No, I don't. I don't buy anything at new highs. My job is to find it when no one wants it, not when everyone wants it. This is an offshore driller, I think. Let me just double check. VST. There's someone promoting the shit out of this stock because I get the same question every single week. And it seems like everyone's amped up on this. And it sounds to me like they're going to get distributed on their heads. So look, cash flow has been flat for 3 years. So yeah, they're using that to buy back stock. What do they do? Is this a utility? Okay, so this is a utility. So they're all thinking it's going to be the AI derivative play. Just play it through just play it through natural gas. It's a better derivative play at a lower price. Let me just take a look here. You missed this. It could go higher, but you missed it. I mean, bottom line is the time to be looking at this was when it was at $10 and $15 and they couldn't give it away. After a 10 bagger, you get the crumbs. If it goes to 250, to take that level of risk, let's take a look here. Okay, so they're still growing. And they're buying back shares. Okay, so that's not a bad thing. But they bought back 30% of the float, and the stock's up 10x. Generally a low return on invested capital business. Free cash flow, let's see what that's doing. It's down off last year. I've just seen this movie before. I understand, like, if you're just looking black and white at the data, if you have 30 years of experience seeing these promotes come and go, you kind of just like, yeah, I've seen this movie before. It's not going to end well. Does it go to 300 before it goes to 50? Maybe. But that's a trading gambling game. That's not really a game I want to play. Let's take a look at total liabilities. Long-term debt is $15 billion, up from $5 billion in 2016. Cash is, so they got $1 billion of cash and $15 billion of debt. And they're buying back stock like there's no tomorrow. Why don't you pay down a little bit of debt? Yeah, I don't like that. I think this is a complete promote. And they're buying back stock to get themselves out. And take a look at all the options they have. They're probably, I'll bet there's a lot of exercising of options going on into that buyback. So I'm a pass. UNH, same thing. Good questions though, Rick. Mike Makos. Oh, sorry. Keep bringing that one up. Byron Firestone sent in a question earlier, but forgot to include United Healthcare. Everyone keeps asking me, no, not yet. Recency bias, ladies and gentlemen. You think it's cheap relative to this 10-year historic run. I think the distribution is kind of just starting on that one. I'm not going to touch that. I think in the short term, it's going to bounce for sure. As a trade, yes, but as a long-term investment, no. No. AEO from Dan S. I think we've covered this a million times. Yeah, you get a bounce, but I mean, I like consumer discretionary right now. I think this is a trading stock. This is not the type of business I want to own. And it'll be fine. It'll probably bounce up. You'll make $8 or $10 and get the hell out. PII. Same thing. Let's take a look. I don't like these recreational vehicle businesses. They're low quality, but they get beaten down enough. I know FOXF was a big one. I mean, these revenues are like, revenues and margins are just collapsing on this thing. I mean, maybe low rates will help it. I don't like these businesses. I mean, let me look at FOFX. Everyone was asking when it was when it was right here, everyone wanted to buy FOXF because of recency bias. You missed it. It's full distribution. This bottoming is going to take forever. I'm just going to steer clear of that. I don't like it, but it probably works as a trade. Muhammad A. Hey, not a question, but wanted to say, do you miss the good old days when China was uninvestable? Yeah, I do. I mean, at some point you get, it's like, if it was still down in the 60s and 70s, would I be adding more? I mean, we got enough. I mean, we brought our basis down to 82 and change. I'm fine. I mean, I got it so much. Xi Jinping is getting a Christmas card for taking so long. All right, that's David. All right, Brian. Okay, Byron Firestone asked, hope you're well. Been sharing your podcast with all my friends and family because I think you're truly amazing and I've learned a lot from you. Thank you. Very kind, and I'm very grateful for you doing that. Hopefully be a client in the future, but not there asset-wise yet. My question is, you'll get there. My question is about Regeneron. Regeneron Pharmaceuticals seems like they are down about 55% from all-time high, and earnings seems to have slowed since 2021, but not over the past 2 years. Your thoughts? I've been watching this one, Byron. So we haven't done anything yet. We generally don't like to buy individual biotech stocks. We own the basket XBI. I think that's the better way to play everything right now. But it is a great company. I think their Ilia sales slowed last quarter. I mean, cash flows come down. Revenues have been flat. Gross margins are really declining. So I have to understand the turnaround story better. This is one I'd probably stick a alert on for under 500, and at 400 load the boat. I don't know if I'll ever see that, but I think it's going to take a little while to build a base on this one. I think you're right, but I think it's early, and I want to see some signs of recovery first, which let me just take a look at a couple of things here. Yeah, still generating a lot of cash. What's going on with the share count? Pretty flat. Balance sheet's probably fine. Yeah. Yeah. I mean, if you have a 10-year horizon, it's okay. I just don't see that it's actionable right yet. Griffin Brown. What do you see will be the impacts of the drug price reductions on XBI? I wouldn't worry about it. They're gonna spread it out across other countries. They're gonna fight it. The drug companies always win. At the end of the day, it's always been that way. All right. Curious about IIPR. In one of those big new client accounts, XBI was a new position. It's no problem with that one. And we generally never do ETFs except for that one sector. We only do individual companies. Curious about IIPR. This is for, I think someone asked about this. There must be someone promoting this piece of crap. It's like a weed REIT. Innovative industrial properties. Regulated cannabis facilities. Taxes real the year ended. Too many things outside of your control. Don't make life hard on yourself. Just go after easier. Put that in the too hard pile. You can't handicap what's going to happen in that industry. And if you can, there are probably better ways to play it. Mr. Hayes, when you decide to buy or sell stock based on fundamental thesis you have developed, do you ever use technical indicators to implement your buy or sell decision? Pro tip. Yeah, I mean, I look at all the standard things, but they don't really play a bearing because if I'm looking at it, it's already down a lot anyway. So I'm not worried about the last $5 or $10. So the answer is no. That's more for trading. Let's see here. Delete. All right, here's a jokester saying he's Donald Trump. All right, that's not a question. That is a attempted joke. Appreciate it. Next time, be funny and I will laugh. All right, Professor Tom. Yeah, portfolio weightings I can only go through with clients. Nirij Bansal. Microchip. I think we've covered this one. I don't like it. But it probably works. MCHP. Yeah. I don't know. With this much deterioration, the stock hasn't really fallen enough in my estimation to justify taking a bet. You know, if this was a $20 stock from 100 with this much deterioration in the business, I'd be interested. But the fact that it's down like 30%, I don't like it. And there's no clear signs of turnaround yet, but it'll probably work as a trade. All right, here's a guy calling for the end of the world last week. I guess that was before the UK deal, talking about, must be reading a lot of Zero Hedge. Although Zero Hedge has turned more positive lately. All right, Drew Robinson says, was reading The Intelligent Investor today and came across this line, quote, if he is the right kind of investor, he will take added satisfaction from the thought that his operations are exactly opposite from those of the crowd, end quote. Could not think of a more fitting line for the hedge fund tips community in 2025. I agree. Now to the question. Thoughts on UPS? May have covered this recently. I did cover it last week. I think it's right, and I think it's a little bit early. So I just think it's going to take a little time to build a base. They've destroyed a lot of institutional holders. I'm willing to be wrong on that and miss it, but I think just give it a little bit more time. I think if your time horizon is over 5 years, you should buy it now. But I really like buying great businesses when they're just so destroyed. I mean, right now it's like, yeah, it's pulled back to where it was pre-COVID. Cash flow starting to recover. Margins are still crushed. Not yet for me, but I like the idea. Just not right yet. So with that said, we'll be back next week. I have no idea what time. I do know the place is going to be Dubai. I think it'll be on Tuesday. In the meantime, make it a great one. Bye for now.